And that's where there's people who make lots of money in real estate and people who don't. Paying into a house for 4 years, then selling it is better than paying rent and losing that money in most cases. So Cook, you are right. In most cases, on average, that's a good idea. Now, the point of that though is that what I want to point to is a warning. Sometimes if you buy the house on the top of the market and 4 years later you sell it and the market dipped, you did not pay down the equity that much. So the equity that you've paid down the loan the first 10 years barely touches the principal. So in the sense of saving money on rent, yes, a lot of the times the cost to own a home is less than rent. So if you account for that, that's a lot of savings. But in rare situations when the market tanks, you could be selling your home for less than what you bought it for 4 years later. So always keep in mind, real estate is a long-term play. Your time horizon has to be 5, 10, 15 plus years. Otherwise, you have short-term risk. But because every property I buy, I plan to own it forever, I don't have that risk. I don't have the short-term risk exposure. Because what does it matter what it's worth if you're never planning to sell? What matters is, am I bringing in money? Is a rent coming in? And that's why location is key.
Question here, is it better to take a 70% HELOC rather than an 80% to avoid my credit line from being frozen during an economic downturn?
During an economic downturn, they were freezing. My dad had a HELOC and it was, I think $150,000 and they dropped it down to 40K. So during an economic downturn, you having that little 10% equity isn't gonna make much of a difference. The second you start seeing things going down, pull the equity out, pull the cash out. Because even if they shut it down, you already have the cash. All they can do is tell you that, hey, you can't take any more money back, and every payment you make, you can't actually take out anything extra. You can only make payments. You can't withdraw any extra funds. So what does it matter? You already took all the money out. And now you have cash when other people don't.
Is it true that buying a fixer-upper is better than buying a full-ready remodeled property?
Not necessarily, because a lot of the deals, I look at like 1,000 deals, and I'm not being facetious when I'm saying this. I literally look at 1,000 deals before I buy one. So when people tell me about a deal, I can normally tell them all the details about the property that's for sale in this market because I already looked at it, ran the numbers, got an idea, and determined I don't like it. When you look at most of the opportunities where you have a property that has not been remodeled and needs to be remodeled, most of the time in the current market, by the time you purchase it and remodel it, it's actually more than if you bought something already remodeled. So you have to be conscious about running your numbers to see what is the best. But the warning also is if you buy something that's remodeled, make sure you double check everything that was done. Because many times people will put just lipstick on a pig and there's still major issues that need to be handled behind the wall that you can't see. So make sure you get an inspection, have someone that knows what they're doing, look at the property. And that's where there's people who make lots of money in real estate and people who don't. Because the more that you know, the more you study your market, the more you study what type of real estate's for sale and potential issues that come up, and you checking to make sure that those are already been resolved. Otherwise, if the last owner didn't resolve it, you're gonna have to resolve it. That's what determines who's profitable. The people who study the market, know what's a good deal in a certain area, and know what needs to be fixed to resolve the issue before it becomes a major problem. Lots of little details that can make lots of profit or lots of losses. So be conscious, be careful. So build multi-unit instead of buying pre-existing. Yeah, if you can build multi-units instead of buying pre-existing and the price is the same as something that's existing, yeah, build a new one, get lower insurance, make it super energy efficient, and you're gonna have no issues for many years. Now, since that's hard to do, because if I bulldoze one of my buildings that I purchased and try to build a brand new one, issue is one, the cost is too high to do that because our entry point is too high. But two, you'll lose unit count. The city won't allow you to put back what was there. So because of that, I end up just remodeling this thing. And when I buy them, I usually gut everything and remodel everything. So it's as if it's like a brand new house. Roof, electrical, plumbing, AC, insulation, drywall, kitchens, bathrooms, flooring, paint, Cat 6 wiring, coax cable, cameras, everything is done like a brand new home and like a high-end property, water filtration, water softening system, everything. This way, I don't have any issues for 15 or 20 years, and it's very energy efficient and reliable. So if you can't build new, then make your property like new, is my strategy.
Or spend on the front end, save on the back end.
Invest in the front end, save on the back end, make a lot of money. And remember, if you're doing that, just think about it. If you buy property for like 880, so 900, if I buy property for 900, we're going to put in roughly like say 300. So we're in for 1.2 million. We're going to do that all up front and bundle that into the mortgage. The payment, on average, $100,000 increase in your loan amount is roughly $400 a month. That's not a lot of money. $1,200 a month is not a lot of money for $300,000. So now the property is fully remodeled and it basically costs us $1,200 a month more in a mortgage payment. That is better than spending $300,000 over the next 5 to 10 years to fix a property up. Because the $30,000 a year in remodeling and maintenance costs, that's going to eat up most of your cash flow compared to $1,200 a month. And in addition to that, as you're fixing the property up piece by piece by piece, you're losing rental income because you don't have a tenant paying you rent while you're remodeling it or repairing issue after issue. Lastly, if you fully remodel the property up front, you're going to be able to get the top rental value for your property. If you just do some remodel, piece by piece by piece, you might be able to incrementally increase your rent, but not truly enough to make a significant impact on your pro forma and on your profit. So at the end of the day, when you actually go through the process, so many headaches with tenants, so many times that your property is left empty, and you have so many issues and not because you don't have any cash coming in. By doing it up front, it is just so much easier, so much more profit, easier to burr the property. It's just so much better. It is harder, but it's better.
What do you recommend starting out in an investment property? 1, buy several properties slowly with loans, or 2, buy few properties outright, no mortgage.
The reason Robert Kiyosaki invested in real estate is one reason, because he can get loans. So if you're thinking about investing in real estate without getting loans, you're missing the point. The American dollar loses value at least 2% a year. The reality is it's been averaging more than 3% a year. And in this last year, the purchasing power of the dollar has gone down at least 7%. And that's the estimate from conservative government agencies. But in the reality, we've seen at least, in my opinion, I've seen at least 11% inflation. That means the purchasing power of your dollar has gone down 11%. Which means if this year a car cost you $100,000, next year the car will cost you $111,000 for the same car. When you get a loan, you are shorting the dollar. If you guys don't know what shorting is, Google how to short stocks. When you're shorting the dollar, you are making money as the price of the dollar falls. How do we know it's going to fall? Because no matter who is in government, who's the president, if it's a Democrat or Republican, they spend more money, they print more money, they devaluate the currency, which causes the dollar to fall, which means shorting the dollar has been a consistent win for the last 40 years. In that scenario, you're winning money by shorting the dollar when you get a loan on a piece of real estate, plus you're winning on a piece of real estate as the asset value increases. Why does asset values increase so much in real estate? One, the supply of real estate has been diminishing compared to the demand. There's not enough housing in this country. We're roughly 3 million housing units short from what's needed. Two, the dollar keeps being devaluated, which makes all assets worth more. If they did not devaluate our currency, the real estate prices would be roughly the same. You'd be just making your money off of the rents. The rental margin would be a lot fatter. Just like in 1980, they were running the margins on real estate were like 18%. Today, if you get 6%, that's good in a good market. So you have to play the full game and look at the full picture to win. And to answer your question, I would basically do exactly what I did, except be more confident. I wouldn't have bought a duplex in my first deal. I would have bought a fourplex. I would have gone bigger because the return on investment is so much more. And the work that it takes, the energy it takes to do the deal isn't that much more.